very esteemed members of the institute who are logged in here for this very special program of our Management Accounting Committee, the Honorable Vice Chairman Gyanchand Misra ji of our committee, very esteemed and versatile speaker for the day, Sri V. Nagappan sir, the secretary of the committee, Dr. Surendra Pal, and his entourage of staff who are seated before us. Good afternoon to each and every one of you. The Management Accounting Committee, no doubt, is a committee of the institute with enormous expertise, because a person like Dr. Surendra Pal is the secretary, and we have Gyanchand Misra ji as the vice chairman, the newly elected Central Council member from the Central Region. This committee looks at the top management perspective, looks at the managerial aspects of chartered accountants, which has been overlooked many a times. People are told that chartered accountants are related only to finance and all those stuff. But then time and again, history has been replete with examples that chartered accountants have been best managers, have been best management professionals whenever there are testing times. And currently, we are witnessing the testing times, wherein you know that the Russian and Ukraine war, which never takes a time to rest, or there is no end in sight, and with the global economy going ups and downs, and the United Kingdom's indecisiveness of choosing a prime minister very soon has put the world on turmoil. Not to talk of the United States of America's questions raising about various factors relating to US dollars and the oil and so on and so forth. In these times, the capital markets have a major role to play in terms of emitting signals, because capital markets are those sources which emit signals of how your country is doing, how your economy is doing, not only how the company is doing. So we have here with us today Sri V. Nagappan, who is going to take us to the perspectives of various angles of this. Of course, sir will be introduced also, but I would only tell you, all of you, that you have here with us a very, very big expert here, a person who is much sought after for investment decisions in the southern region. He's also a person who's, let us say, who's who in the government of Tamil Nadu, whichever party is in power, an independent director on various corporate boards. Friends, I welcome on behalf of you, Sri Nagappan sir, for sparing his valuable time. And I know these are market times, but he is here with us today. And also I welcome each and every one of you to this particular meeting. And I also request now Gyanchand Misra ji to offer his remarks, and then we can hand over the proceedings to Nagappan sir. Please, sir.
So thank you, very respected chairman of the very important committee of the institute, Management Accounting Committee, very dynamic, and as well said by Rajendra bhai, one of the very intellect person in the capital market from southern region, Nagappan sir, officers of the institute, and of course, respected participants. Indeed, it's a great pleasure for me to welcome all of you over the virtual program we are having today on the capital market with respect to the management perspective. So friends, nowadays, well said by a respected chairman, the situation is lot of things are happening in and around. Today morning itself, IMF has downgraded the rating of India with regard to the capital growth, GDP from 8.4% to 7.2%. And we can see that as of now, the activities are happening in such a fashion, like GST collection is mapping all-time high, other side inflation is mapping again high. So how the equilibrium point is going to establish in the capital market is really a point to be discussed and to be taken care of. So friends, I'll not take much time, as on behalf of the committee, and of course, like younger brother of our chairman, Sri Rajendra Kumar PG, as vice chairman, I welcome each and everyone, core of my heart, and I'm sure with the deliberation and understanding of Nagappan sir, we shall get benefited, and we will certainly map up the new ways to come up with the better understanding of the capital market in coming time. So thank you, RK sir, for giving this opportunity to interact with the members, and welcome Valappan sir in the committee today program. Thank you, sir.
Thank you, Gyanjan Mishra ji.
Capital Market Committee Chairman is also here.
Sir, Capital Market Committee Chairman CA Anuj Goyal ji, very senior
Acha,
council
Anuj
member.
Goyal ji is also here. Anuj Goyal ji, welcome, sir. Welcome, welcome. Sir, where are you? Where are you, sir? I am not able to have a look. Oh, wonderful, wonderful. Sir, welcome, sir. Please, please, as a Capital Market Committee Chairman, why don't you offer a few words, sir? Please. We have a specific committee for capital markets.
Yeah.
Yes, well, sir.
Yeah, thank you, RK sir. Popularly known as Sir in southern part of the country, the chairman of the committee, and the vice chairman, CA Gyan Mishra ji, and of course our honorable resource person, and all our honorable members from each and every part of the world, I will say, through technology. I think we are in a position. Capital market is very, very important. Management accounting is very, very important. And I think the members of the Institute of Chartered Accountants of India can really do wonders in the field of management accounting. It is practically the core area of the members of the Institute of Chartered Accountants of India as far as the management accounting is concerned. And as far as the capital market is concerned, I think this is the area in which unless and until the members of the Institute of Chartered Accountants of India will be coming in a very, very aggressive manner, in a very, very proactive manner, whether they are in industry, whether they are in practice, I think it would be really very difficult for our country to reach to that position with the potential which we are having. And I'm really very happy that the chartered accountants are understanding that thing. The Institute of Chartered Accountants of India is also very, very proactive. And you will certainly appreciate that 9 out of 10 players in the capital market, the top players, you will find the members of the Institute of Chartered Accountants of India, whether it is Rakesh Jhunjhunwala, whether it is Ramdev Agarwal, whether it is Motilal Ostwal, each and everyone, you will find them a member of the Institute of Chartered Accountants of India. So the capital market is very, very important for the chartered accountants, and the chartered accountants are very, very important for the capital market. And I'm quite confident when we are having the leaders like RK sir and GC sir, we will certainly see that how the members of the Institute of Chartered Accountants of India can really sharpen their skills further and can really lead this capital market from front. And I'm quite confident when our members will be there to lead this capital market, our India will certainly reach to the top 2 economies of the world very soon. After China, I think India will be going to be the second largest economy of the world, overtaking, of course, the United States of America very soon. So I compliment all our honorable members for being the part of this wonderful session. Thank you very much.
Thank you, Anuj Goyal, sir. In fact, sir was the former chairman of this particular committee, and I was his vice chairman. Thank you, Anuj sir. Over to you, Nagapan.
I know, sir. I know. I have worked with you, sir, earlier also.
Over to you, Nagapan, sir. Over to you.
Yeah. Good afternoon, friends. Good afternoon to all of you. First of all, I would like to thank the ICA. ICA always has been kind to me, inviting me, particularly RK sir my good friend RK sir used to invite me for the budget presentations and all to SIRC very frequently. I've been there. And I would like to thank the CMA, the Committee on Management Accountant for inviting me here, the chairman CAP Rajendra Kumar and CA Gyan Chandra Mishra, and of course the chairman of Capital Market Committee is also there, Mr. Anuj Goyal ji. So I would like to thank all of you first of all for inviting me here. It's always a pleasure to interact with chartered accountants. And today, in a way, it's an important day because I'm going to touch upon a few topics related to capital market in relation with top management as well as individuals, on which are mostly of recent developments. One such thing is ESG, environmental, social, and governance issues related to companies and the markets. And then I said it's a very important day in a way because yesterday SEBI has notified the framework for social stock exchanges and social enterprises for them to get themselves listed in these social stock exchanges or SSC, which will benefit many social organizations to raise resources and to help the needy. So we'll touch upon that as we progress. And I'm also going to talk about, apart from ESG, I'm going to talk about the markets, capital markets today, and the extreme volatility, and how to tackle the, or how to go about risk mitigation, the process of risk mitigation in such a scenario through diversification or asset allocation or hedging, whatever it is. So let me start first with a presentation on ESG, and then we can move on to the current market scenario and the valuation, volatility, and all those things. So I'm going to share the screen. I think I'm allowed to share the screen. Yeah.
Screen share. Can you allow the screen share facility to the
Yeah,
speaker?
it is allowed, sir. It is allowed. I'm only trying to.
Okay, okay.
Yeah. Just a minute.
So now you may try it again.
1 minute. Sir. I'm just. Yeah. It's good. You're able to see the screen, sir, now? Yeah. Yeah. So the first part of it, which we are going to discuss, is environmental, social, governance issue related to the companies. And let me start with the IPCC 2021 report. And it's an intergovernmental panel on climate change, where various government agencies participate in it, and it's a United Nations body. And they've been mandated to study the effect of human activity on the environment globally. And they submitted a detailed report on August 9th of 2021. There is a sixth report. It's a continuous process. They keep updating the data. And the last report was on 2021. And they submitted, it's a 3,000 pages report, detailed report, done research and studies globally. And based on 14,000 scientific papers, this shows the credibility of this report, and 234, more than 200 experts were involved in it. Now, what does it say? There are, what is in store for us? Extreme heat waves are going to coming, and which I think we are facing it in many parts of the country. And particularly as far as India is concerned, it has got 7,500 kilometers plus of Indian, coastline, which is vulnerable to this heat wave, and the sea levels might go up. And because of the sea level going up and this heat wave, more than 28 million people, are exposed to flooding. Chennai, for example, if you ask me, people are saying that 50 years down the line, the places like Elliott's Beach or the Marina or the Besant Nagar may not be there. So cautioning has to be at this rate. And assets worth 4 trillion are at flood risk. And this NASA report also says 2.7 feet will be underwater in 80 years. And we may think the 2.7 feet is not much, but then it is really, to calculate most of the places, coastal areas, 2.7 feet is really high. The height is too much. And 75% of Indian districts in the coastal area will be covered by this, high coastline issues. 2019, by and large, is the 7th warmest year since 1901, and it is the statement of CRIDA, which is Central Research Institute for Trial and Agriculture. And India will lose 2.8% of its GDP because of this by 2050, because of this extreme weather. It could be much more than this, I believe. Now, who is responsible for this? Are corporates alone responsible for this? Are individuals not responsible for this? And how do we tackle this? One simple example is that, if any one of you is reading this Down to Earth magazine, they keep cautioning us repeatedly again and again about the problems faced by the earth and the steel companies. I think that's one of the, it's not the only one, but that's one example. But then, if you look at individuals, how many of us still use wooden pencil? How many of us use mechanical pencil? How many of us use fountain pen? How many of us use the ballpoint pen? How many of us use the pen which are use and throw pens? There was a calculation done in a college. In a classroom, an average student may uses one pen a month. So in a 12 months, in a year, he uses 12 pens minimum in one color. If it is red, green, some people use 2 different colors, 3 different colors, it's more. And in a class, 60 students are there in a class. So a classroom, one particular class or one section uses more than 700 pens, use and throw pens. And if the college has got 20 different departments, commerce and various departments, and more than 14,000 pens are used by them in a year. And if a student is studying for 3 years, in his entire thing, that all the 3 batches put together, they are using 43,000 pens. This is about only one college, and multiply this by number of colleges, universities, and other institutions in your area. So this does not include schools. This is one simple example of how individuals, all of us, also contribute to this. Now, what is the impact on the society, and what is its impact on our lifestyle? There are a lot of
Here's
issues.
something I found on the way.
Yeah.
According to OPC's.com,
1 minute.
cultural impact and effects on individual and society in their lifestyle.
1 minute.
Language, tradition and education from surrounding environment with their sources of
Sorry. Sorry, my Alexa is very sensitive, so it has started responding to something what I was talking. So now, if you look at ESG, I think all of us, as chartered accountants, I think we are very much aware of the governance issue in companies and failure of governance issue. If you look at in the recent past, in the last 2 decades, if you look at it, Enron is one such issue where, for those of us who want to learn more about the Enron issue, you can read The Smartest Guys in the Room, the book written by Bethany McLean and Peter Elkind. So I think it very clearly explains what happened in Enron, a company which was, one of the oldest companies in United States of America, which was running very well, which was doing very well, and which was contributing to the economy and welfare of the society, of the public, serving the public. Suddenly, some greedy top management people came in, and they thought that the power is traded in 2 different rates in a year. In a peak demand season, the power is priced very high, and in the non-peak season, the price is low. Now, they wanted it to be somewhere closer to the mean or median rate. So they started trading in power online, probably in early 2000, 99, 2000, during that period in the futures market. Initially, everything was all right and nothing, not a major problem. But then later, for the sake of making profits, Enron or the chief executives or the top management they started concentrating more on trading than what their core business is, what they were doing, So that led them to build up the balance sheet, build up the annual reports, and artificially. And once the trades went on the negative side, they started having a lot of shell companies, did fake trades, and incorporated everything. And one fine morning, everything came out like how it happened in Satyam Computers in India. So Satyam Computers, you all know what happened in Satyam Computer and the famous letter he has written, Ramalinga Raju has written on catching hold of the tiger's tail. And one analyst who questioned during the Q2 results, if I'm right, the September results was published in October or November or December, I think. In that meeting, someone questioned that you have so much of cash, then why do you go for where you're not declaring huge dividend and all. Then the probe started, and meanwhile, parallelly, the management also came out with the truth. And what happened in Satyam Computers is a history. And then with good governance, we are able to bring it back to normalcy and got it merged with Tech Mahindra Group. Then the recent issue, if you look at it, there are two clear issues. One is DHFL, Dewan Housing Finance Limited. The second one is IL&FS, where the governance issue was a major issue. Governance failure was a major issue, which led to a lot of issues. Of course, many of you know that what happened in National Stock Exchange, the less said, the better. I think most of it is in public domain. And the list goes on. These are major issues which are concerning. And every time when such failure happens, the losses are not 5 crores or 10 crores, like we used to talk about 1 or 2 crores in Mundra, the first scam of independent India. But today it's every scam costs several thousand crores. So that's where the ESG plays a role. Environmental, social, and governance plays a role. It's a set of standards for a company's operation. That socially conscious investors, look at, and they screen based on those parameters, and they use it to invest. So what are those three criteria? One is based on concern for the environmental criteria, and this considers how a company performs as a protector of the nature. If any one of you is trading in, you're trading in US markets, you will know that most of the apps provided by the US markets, like for example, I trade in using IBKR, Interactive Brokers. So if you are using IBKR, you know that every company, when you screen, apart from giving the EPS, P ratio, the last dividend declared, all those details, they also give something called ESG score. Now, what is this ESG score? This ESG score is based upon how good the company is in protecting the environment, and how they are socially conscious, and how good their governance is. Based on these three parameters, they give a score. And going forward, right now, the youngsters, the new generation of investors, generally they look at ESG. I'm not saying that the older generation investors don't look at it, but then for most of us who came into the market, making money was more important, and we never thought about these things because we never spoiled the environment those days, and governance was fairly good. But then more and more issues are started coming in the last 20-25 years. So ESG has started more, become more prominent. The second criteria, social criteria, is something which examines how a company manages its relationship honestly with its various stakeholders, like not only their shareholders, but also their employees, the vendors, the customers, and the communities where they operate, the surroundings. For example, the company where I was part of, I was an independent director on the board of a listed company called the TNPL, Tamil Nadu Newsprint. And the company completely recycles the water, whatever is used for the making paper. And it's a zero discharge, almost a zero discharge. Technically, it may not be, but then it is 99.999, whatever it is. Then, and it is used by thousands of acres of coconut farmers in and around the plant where they are. And years together. And every time they conduct a check and ensure that there are no problem because of that water. So socially conscious, though, they take out the water, they again recycle it and purify it, and then release it to them outside. It's not, it's taken care. So something like that, how socially conscious you are to your employees, to your vendors, to your customers, various stakeholders. That's something very important. The third one is the governance, which deals with the company's leadership, executive pay packet. Of late, you started seeing, like from startup to many companies, where the difference between the last employee and the top CEO is not 5 times or 10 times. Sometimes it is even 100 times. There are some companies which have published the data also. So that looks sometimes ugly, particularly when the company later is identified for fraudulent practices and the CEO by the time has left and taken all his pay packet. And how do we take it back? So on audits or internal controls and checks and balances and all these things. These are all something which now it is looked into. Now, environmental and energy factors, governance concerns, and social issues become more important, because without this, it is not sustainable. To be sustainable in the market, to be sustainable in this world, you should have a combination of all these three at an optimum level, if not the best, I would say. In fact, the management guru or valuation guru, one of the topmost guru, is ridiculing this concept sometimes in certain angles. I'll talk about it later. But basically, it's all it's around business ethics and how to conduct ethical business in a fair and transparent manner to all the stakeholders without affecting the ecosystem. And when we say environmental, to be more specific, it also talks about lower energy consumption or using renewable energy, pollution control, from all angles, whether it is air pollution or water pollution, from all angles. And then also to tackle climate change, if you are responsible for the more heat being generated in the area, and how you manage the waste. Once again, to quote the example of TNPL, Tamil Nadu Newsprint. Some of you may know this also, that the product which comes out as a waste from a sugarcane or sugar manufacturing factory, the bagasse, now that's being used in an innovative method by TNPL to make paper. Most of the paper companies use wood pulp made from hardwood pulp from other wood by cutting trees. Whereas TNPL very proudly says, when the notebooks, you can see this statement: no tree was cut to make this notebook. Which means it is used out of completely recycled the bagasse which comes out of a sugar factory. They have, I invented long time back a binding material for this bagasse, and with that they are making this paper. And then added to that, when we manufacture paper, there is a lot of lime sludge which keep coming. Now, what TNPL did was that initially they were finding it difficult to dispose it of. And a lot of air carries them and goes into the villages. So they have to keep it moist or carry it and throw it somewhere else. Within a few months or few years, I would say that they decided to use that lime sludge, right, and use it to manufacture cement. Today, TNPL is not only a paper manufacturing plant, but it is also a cement manufacturing plant. Now, at third level, at one stage, what they were thinking was that the plastic waste which is coming out of various imported material, which they use it to mix it with bagasse sometimes to make certain paper. They thought that they can use it to pelletize it and use it for making help them make road laying. Now that has not come. So, but they may do the reverse engineering or reverse methodology where the plastic can be used, recycled, and oil can be extracted out of it. But that is at a very preliminary stage. So waste management is an important thing to preserve the environment. From the social side, human rights, child and forced labor, community welfare, stakeholder and health and safety, which basically CSR takes care of most part of it. And the governance is very important or equally important, if not more. The quality of the management, the board independence, the composition of the board, the independent directors, women director participation, and all those things, and then mitigating the conflict of interest, maintaining arm's length and all those things, which is taken care more by the Companies Act and the board diversity, which I mentioned earlier. These are all the broad ESG framework covered. Now, ESG is also one more tool for investors to evaluate. If you look at it, there is a set of investors in the market. It becomes very important for management to look at it because the money, the management wants money to come into the company when they go for expansion, when they go for diversification, they have to be careful to look at the ESG score, particularly in context of the younger generation investors who are coming into the market. This is something similar to themes like Sharia compliant investment or Sharia compliant ETF, which invest only in Sharia compliant stocks. This particular ETF don't invest into banks because banks handle interest and does not invest into liquor. So similarly, veganism based investments, which avoids leather goods or liquor or cigarette manufacturing companies. So similarly, ESG is also one important investment concept, investment tool people have started using. Though it's not very popular in India, but it is gaining currency in many parts of the world. Green funds are coming, more and more green funds now coming into India also. So if you go to Singapore, they have this recycling, they call new water, NEW, new water. New water is nothing but recycled water, which is used for, 50% of it is mixed with natural water and used for drinking, used for all the housing HDBs are supplied with that water, new water. And there are more and more small cases. If somebody is trading in the market, will know that small cases are very popular now, based on ESG. Many mutual funds are coming out trying to, based on this thing. And in a way, it helps investor to avoid companies that might pose a greater financial risk due to their environmental or other practices. For example, 20 years back, almost 20 years back, one court in Kerala High Court, the Kerala High Court banned smoking in public places. The share price of ITC crashed that day. Why? Not because only Kerala banned it. That set precedents for all other high courts to do that. And at one point of time, it become, most part of the country now, smoking in public places is banned. So the share price crashed. So, but luckily the company realized it and they diversified into other products. And today, more than or close to 50% of the revenue comes from non-cigarette products. So the company has mitigated the risk. Otherwise, it would have been a big risk for the investors. So the company is trying to become ESG compliant over a period of time. Probably they may hive off their cigarette division and the rest of it will become ESG compliant. We don't know. We have to wait and watch. And as I said, this is mainly important for sustainability. For example, if you're going to make paper and if you're going to keep on cutting all the trees, is it a sustainable business model? The next tree takes almost 20 years, even hybrid takes 5 years minimum. Some of the paper companies like TNPL has invented and tried certain hybrid varieties which can come in 5 to 6 years. But even that takes 5 to 6 years. But if you keep on cutting trees, what will happen ultimately? It's not at all sustainable. So you have to come out with a sustainable model, in which case ESG is very important. Though it may look that the initial costs are higher, but over a period of time, it will average out. For example, for costing, people who do costing based on ESG, environmental issues. If it costs 10 rupees to make a paper for a company like TNPL, and if it makes, I'm just quoting for example, if it takes 9 rupees to make a paper for ITs, we may normally say it is 10 rupees is expensive. But if you look at longer period of time, TNPL cuts less number of trees. In fact, very, very minimal, whatever they need to mix for certain varieties of paper alone. Whereas ITC may be cutting large number of trees. So it will take a longer time for the society to get back all those trees, grown up trees, shade, oxygen, everything. So there is a problem there, and that cost has to be added. Anybody who does costing based on environmental, some companies follow that internationally. India, we have not started. I don't think we have any companies following that kind of a costing parallelly to publish in the paper. And that's where, some people, it's not ESG is not without flaw. ESG is not this thing. ESG, there is the issue. People like, the valuation guru like Aswath Damodaran, a well-respected valuation guru globally. He says the goodness is very difficult to measure and the task will never get easier and there will always be very skeptical. He says the claims made by the people who advocate for ESG and the benefit it bring to the society. Some of them, he says that they are vested interest. Though it doesn't mention in this article, he has mentioned in some other article. And he believes that ESG will cost the companies a lot, and hence it will cost the investors also a lot. And he feels that it will create more. 1 minute. Switch off. He also says that there are studies of ESG scores influenced by company size and location, and the larger the companies, they get higher ESG score ranking than smaller companies. And developed markets are getting higher scores and ranking than emerging market companies. And this is, if you look at it, that the issues investors want addressed by their portfolios again vary from age to age, between different age groups, there is a different expectation of what is ESG or what main issue should be addressed by the company or by the concept of ESG. There are issues like global warming. There are issues like impact of plastic on the oceans, where fishes eat them, and then when we eat fish, we eat so much of fibers and plastic. That's a lot of studies confirm that. And there are issues like sustainability. And the younger crowd thinks more about. If you look at this chart, you can very clearly see that the people at 25 to 39, and most of them look at what they are looking at, and people at 55 plus what they are looking at. More of them, the second category, looks at data fraud or theft and gun control as more important than global warming or impact of, than sustainability as an issue. So these are all different expectations, though ESG is one concept, one single concept, but there are different facets to it, different angles to it, which gains currency in different age group in a different rank. Okay. When they were asked to rank, these are the ranks they have given. Now, what is the Damodaran's what is his thing? He says the being good will add to value some companies, but hurt others and leave the rest unaffected. So there is a mixed reaction. Good to some, well, no, it adds value to some, it hurts some, but then it leaves somebody else unaffected. And he clearly explains in this chart, when you look at it, what is the ESG effect and what is the evidence. Okay, and there is little evidence that the good companies are able to grow faster than bad companies, but there is some evidence that it is more difficult for good companies in some sectors to scale. Similarly, he gives various reasons why there is a problem with this kind of measurement and all those things. So now, how does ESG affect value? For any management, what is more important is that how being compliant with ESG, giving more importance to ESG, how it affects their value. Now, he says, being good increases the value either by increasing the cash flows or reducing the risk of life, the risk of environment getting spoiled, the risk of water getting spoiled, the risk of air getting spoiled, and in turn affecting the health of the employees and various other things. So this is one way. The other one is, being good has got no effect on the value at all, with any benefits being offset by the cost. There are some benefits, but there are some costs attached to it. So when you analyze the cost benefit analysis, both are equal. So it is neutralized. And the third angle is that being good has got no effect on the value without any benefit, but being offset by cost. With you say, there are three types. So you have to analyze that in whatever industry, whatever business we are in, whatever trade we are in, where we are, and how this will affect us in terms of cost and benefit. We have to evaluate the cost benefit and then go for it. That seems to be the answer thing. And the one accusation by the people who are against the ESG is that the market is overestimating the benefits of ESG, the benefits of being good, or the cost of, inversely, if you ask me, the cost of being bad. So that is something which which is one accusation or something when when pricing the market. And when you look at long-term returns to ESG investing, it is investing in bad companies will generate higher risk-adjusted returns than investing in good companies. You may be investing in bad company, but it will generate a higher risk-adjusted return. You're providing for risk, you're adjusting for risk, but in spite of that, it may provide higher rate of return. For example, ITC, though 50% of the or closer to that is non-cigarette income, but that does not generate major bottom line. The bottom line still is major bottom line. More than 75-80% comes from the cigarette manufacturing only. ITC is struggling to reduce that bottom line, though they are successful in addressing the top line growth, but bottom line growth is still it's a problem. And there are situations where market fairly estimates the benefits of being good or bad. There are situations where market underestimates the benefit of being good or bad. where the investing in good companies will generate higher risk-adjusted return than investing in bad companies. So these are various situations which we have to evaluate. There is one single methodology to adapt or say that simply ESG investing is good. It is beneficial than the cost spent. We have to anyway, and this is in a way. Again, it's not my slide. This is a slide which I've taken. The credit goes to Mr. Damodaran, or the credit or debit, whatever it is. If you want to scold him, I mean, this slide is bad. It is because of him, but it is good. It is because of him. But what he's trying to say is that who really benefits out of the ESG. Now, let us say that there is going to be ESG ranking or ESG score, which is measured, which is already there in place. Now, there will be a set of people who come in, who will call themselves ESG measurement services. We are providing ESG measurement services based on the various parameters, and use their disclosure to create ranking based on ESG, and they will create indices, ESG indices. Here, there will be a set of companies with the ESG, the index with the only ESG compliant companies, and they will generate revenues from selling those ESG scores, revenues from providing this index facility to a stock exchange like Nifty or Sensex. There will be a ESG index, and there will be a ETF based on that ESG. It is there already in many. So you can. These companies will benefit out of a product which was not there earlier. Now they will create a product. They will create a service, and they will benefit out of it. This seems to be a sort of an accusation which he is trying to place on those companies or those firms which are trying to provide that services. And also he says that the disclosures. Now the accounting firms, they have to who interact with the companies, publicly listed companies or unlisted companies which are there in the public place, but who are supposed to disclose. Now they have to come out with the disclosure requirements and how much of pollution they have done, how much in air, how much of pollution they've done in air, how much they have not done, whatever it is. So there are ESG disclosures. So there will be ESG consulting company, consulting firm, and they will advise for a fee with Big Four or other audit firms can do this, or some other firms, technical firms can do this. And there will be ESG based investment, which I said earlier. They will create ETF based on the indices based on ESG. There will be an index which is based on ESG, and that index will be converted into a ETF, and we can invest. There will be a mutual fund based on ETF. So he says that ESG, whether it benefits the companies or not, ESG, whether it benefits the society or not, considering the cost, ESG benefits the consulting firms, ESG benefits the measurement services, disclosure, the services which the companies which provide that service, and ESG investment. So, I mean, this is a skeptical way of looking at things probably, but I think the truth lies somewhere in between. We should find a kind of a, strike a right kind of a balance between them. In market, there are indices. Now, Dow Jones has got a sustainability index, emerging markets index, which comprises emerging market sustainability leaders, which is identified by Standard & Poor Global, S&P Global, through their CSA, which they do on a regular basis, corporate sustainability assessment. And this process, this aims to represent the top 10% of the largest 800 companies in 20 different emerging markets like India, based on long-term economic, environmental, and social criteria. Based on this criteria, they take the companies from 20 different markets, all emerging markets. And again, in a way, if you look at it, that this is not including the mature markets. It discusses about emerging markets. Okay. See, now if you look at it, Standard & Poor Dow Jones indices made this change last year. Just to tell you, just to give an example, not accusing anyone or not finding fault with anyone, but just a fact, stating a fact that the Dow Jones Sustainability Index made a change. Adani Ports and Special Economic Zone that was removed from the Dow Jones Sustainability Indexes, following a media report and stakeholder analysis, triggered by a recent news event pointing at that point of time, heightened risk to the company regarding their commercial relationship with Myanmar's military, who are alleged to have committed serious human rights abuses and all these things. I mean, to what extreme levels they are going to include a company into ESG criteria or not. Now, this is disputable decision, but questionable decision, the company will take it up in case if they are affected. But and it's about the standards, more. I mean, again, I think people who are skeptical about it say that it is more to do with window dressing or annual report, and to mention about it in statutory auditor's report or secretarial auditor report or corporate governance. In fact, all these things are there already. Most of them, these things are, I mean, everything is there. Now we are adding one more thing to the checklist. Is it needed? This is one question being asked. Okay. So I spoke about some of the case studies, DHFL and TNPL. Like I said, Tamil Nadu newsprint utilizes 1 million ton of bagasse, which is a renewable residue from sugarcane, and thereby avoids about 30,000 acres of forest land from commercial exploitation. And it recycles waste paper. Waste paper is also used as one of the raw materials for pulp production to mix it with the bagasse to make certain variety of paper. And the solid waste generated from this paper mills power plant, like lime sludge, which I mentioned earlier, it is used to produce industry grade cement, which is sold in Tamil Nadu. Over 1,100 acres of land is there to generate clean, renewable energy and rooftop solar power plants. If you really look at TNPL's annual report, TNPL is net to net annually. They don't take even 1 unit from the government. Maybe they take some technical reason, they may take 1 unit of power from the government. Actually, they are the net exporter of power to the government grid. They don't. Today, government says that no power will be provided to TNPL. They can run the plant completely on their own. They have completely captive power plant, renewable energy, rooftop solar power plants, everything, clean energy they have. And okay, I think I will skip some of these things. Okay, I mean, these are views about ESG. This is something very important as an investor or as a company also. When we raise resources, before that we should look at that how much of goodness has been priced in a particular when issue or whatever it is. So that is something which we have to look at it. I'll skip this. Okay. Now the intent is the key in letter and spirit, not with some scores which is generated, which can be manipulated or like it has happened in a few cases. But I'm not saying that everything can be manipulated, but it has happened in the past in certain things. But just because it has happened in the past also does not mean that everything is manipulated. So mainly the thing about ESG is that every company should evaluate the cost and benefit, and the cost to the society, cost to the company, the benefit to the society and various stakeholders and benefit to the company, and take a call on it to what extent they have to be. See, governance cannot be compromised at all, but the other things can be. I'm not saying that it can be compromised, but you have to evaluate the cost benefit and get it, and so that all the stakeholders are benefited. The benefit is more than the cost spent. That is something very important. Okay. Now with this, I'll move on to the next PowerPoint. Have time? I think we have time. Yeah, I think. So now in the next part of this, we can see that the importance of asset allocation during volatile times, the importance of diversification and understanding the market size cycles and quantitative wave theory, and the process of risk mitigation through diversification in such a unpredictable, volatile capital markets. How do we handle it? As a company, as a personal, somebody is managing a treasury, or as an individual also. Most of us like comforting life then and now. Let me talk about portfolio and risk mitigation and what it is by starting with this quote. In choosing a portfolio, an investor should seek a broad diversification. When I say broad diversification, it does not mean that having 50 stocks or 100 stocks. Fairly broad. It is qualitative issue, so it can vary from person to person, company to company, depending upon whether it is 5 to 10 or 10 to 15 or 15 to 20, but certainly not 50 or 100. Further, they should understand that equities and corporate bonds also involve risk, that markets inevitably fluctuate, and their portfolio should be such that they are willing to ride out the bad as well as good times. This is the basic theme of any portfolio. Any portfolio or a treasury manager should be careful that they should be able to ride out the bad as well as good times. If everyone was continuously buying last 1 year, 2021, now they will regret if they are buying only equity. If everyone has invested everything into debt also, they will be feeling bad because the debt was paying very low last year. This year it can, the new fresh issue of debts will come out with higher rate. If somebody has got a diversified portfolio, they'll be happy this year. And the modern portfolio theory also, it says that the total risk of the portfolio can be reduced by diversification to some extent, mitigate, and in certain areas, certain risks like, there is a systematic risk, there is a unsystematic risk, and there is systemic risk. There are some risks which can be mitigated by diversification. There are certain risks which cannot be mitigated by diversification, but can be hedged. So there is a difference between risk mitigation and hedging the risk. So everything cannot be achieved by diversification. Some of it can be achieved by asset allocation. Some of it can be achieved by hedging. So this can be achieved by investing in assets that have low positive correlation, or better still, a negative correlation between two different asset classes. For example, whenever gold goes up, crude goes up. Whenever crude goes up, gold goes up. This seems to be a theory generally. This has been broken in the recent past, but generally this is a theory. Then there is no point in investing in gold as well as in crude oil, so energy sector. So it is better to go something which goes against it. For example, when people say that when gold goes up, stock comes down, or stock goes up, gold comes down. So it is better to have less investing in two different asset classes with less correlation. And to do that, three things are basically necessary. Anybody, first of all, very important is capital allocation, where you diversify between risky asset class and low risk asset class. We say riskless, but then there is risk in everything, but we diversify between risky and riskless. The second level is that within that, you have an asset allocation, you diversify among various asset classes and markets. And within each asset class, within a diversified asset class, you have a diversification. So how do we do that? Now you have risky and less risky. Within risky, you have stocks. You can go into debentures, bonds and debentures, which I consider as part of the risky asset class today, based on the recent past, the experience of the recent past. And the difference is, you can look at it. Asset allocation is stocks, bonds, commodity, cash, and diversification is within the stocks. You go for large cap, mid cap, small cap, or emerging markets, global markets, and Indian market, or sector-wise diversification. You can look at various options. So there's a basic difference between asset allocation and diversification within each asset class. And I'm going for debt. I can go for debt-based mutual fund, short-term, ultra short-term funds, or long-term funds, or bonds, non-convertible debentures, or convertible debentures, bonds, or various products. What it is. Now we all know the various kinds of risk, and based on that, we have to address the risk with the different products. There are global risk. There is a country risk, which includes the political risk like Ukraine and Russia. The recent war was there. So because of which the crude oil prices initially went up, but then it came down because of Russia. But in fact, many of us thought that this is going to affect us. But in fact, the Russian war has helped us by reducing the purchase cost of crude by buying it at lower price from Russia, and it has also indirectly or incidentally benefited us with rupee trade, and demand for dollar has come down, because of which otherwise already with the dollar going up, assume that we are paying in dollar to Russia, then I think it would have been much higher. The other risk is legal risk, like ITC, which I mentioned 20 years back. ITC had a problem. The judiciary banned smoking in public place, which led to the crash in the share price, but later it recovered. The company de-risked themselves from it. Otherwise, the share would have gone. So there are legal risks, and there is an economic risk, which is a slowdown, recession, which is a great possibility. in many of the Western countries, but remote chance in a country like India, in my opinion, in my personal opinion, in my humble opinion. Maybe I may be wrong. There are sector-specific risks, particularly sugar. If the sugarcane cultivation is not good, that particular year prices, production will come down, but it will benefit indirectly in a way because sugar prices will go up. There are risks related to metal. If we are in a wrong cycle, the metal prices will come down and the crash will not benefit the companies. Like last year, the metal prices were up, which benefited a company like Tata Steel to reduce their debt drastically. So they were able to get out of major part of their debt. But otherwise, they would have been in a highly indebted company. And there are various other sector-specific risks. Airlines had a big risk. Whenever the air turbine of the ATF price goes up, airlines are affected if they are not able to pass on the cost to the travelers, which is the case in most of the time. There is a company-specific risk, like when the CEO of leaves a company like Infosys or Wipro, then the company stock takes a hit, and it happened in Tata Group some point of time, and various. So that is there. There is an interest rate risk. There is a currency risk. When Nigerian devaluation happened, Bharati Tele was one of the companies which was affected in a very big way because of their heavy presence in Nigeria. And it took a long time for them to get out of that, manage that risk and get out unscathed. Of course, it affected them to some extent, but they are, thanks to probably Jio, that the rule of three has applied and most of the other players have died and only two of them are strong and one is a weak competitor like Vodafone. But it affects them. And there is a commodity risk. Until 10 years back or 12 years back, US was a net importer of crude. Not many people may remember this. Today, they are exporter of crude, net exporter of crude. The ships had a mismatch. They were always importing crude and the ships have to go back empty. Now they are exporting crude. Ships have to come in empty. So this happened because of they managed making crude out of shale gas. The technology was improved and the cost was reduced, and then they became manufacturer, one of the highest manufacturer of crude and net exporter of crude. So commodity risk is there in case of steel, cement, everything cyclical. And there is, you can broadly classify all these things into systematic and unsystematic risk. Systemic risk on one hand, systematic and unsystematic risk on one hand. Now, how do we handle it? There are many things like, we used to talk about in 2008, too big to fail, Fannie Mae. Many of may remember the Fannie Mae and other companies' names. And, too interconnected to fall. These are the famous popular statements made in those days. And ILFS is one such too big to fail or too interconnected to fall in the recent past. India is concerned, but somehow we managed it. We are not so much interconnected like US. And system breakdown or disaster recovery side, Mumbai floods, Kerala strike, these are all various things. Now, systematic risk, this is a risk which is inherent to the entire market or the entire market segment. And hence, we call it undiversifiable risk because this risk cannot be resolved or handled or, mitigated by diversification. If you diversify also, during the systematic risk, the entire market will fall. So diversification does not benefit you at all. Even if you have a diversified portfolio, the entire market will fall, and hence diversification doesn't help in case of systematic risk. It is not just a particular stock or a particular industry, it is across the market, across the economy. And this is fairly, both unpredictable and it is completely, very difficult to avoid this systematic risk. As I said, it cannot be mitigated through diversification, but you can hedge. For example, if I am long in a particular stock or a particular company or this thing or index in cash segment, I can go short in the futures market, or I can buy a put option where I have a right to sell at a particular price. I retain that right while I'm holding a long in a particular stock or a particular company or a particular asset, a particular commodity. I'm holding a dollar. I fear that US dollar will come down. What I do is I go and buy a put call on dollar, or I sell it in the futures and hold on to my asset. So if it comes down, I only, if it goes up, I only lose the call money, whatever premium I paid. And if it comes down, anyhow, I'll make money out of that this one, premium, whatever I want. So this is the issue. Just for example, to quote an example, if you're putting your, some assets in bonds and other assets in stocks, why diversification? This can mitigate systematic risk because the interest rate shift that makes bonds, less valuable, or the value of bonds will come down. And normally, invariably, the stocks goes up. Whenever the interest rate comes down, the market goes up. Whenever the interest rate goes up, the market. So it's vice versa. The correlation is very different. And similarly, interest rate changes, inflation, recessions, wars, all these things are source of systematic risk because they affect the entire market, not a particular company. For example, maybe interest rate risk may affect certain companies more than other companies, but then across the board, most of these are affected. Systematic risk underlies in all other, underlies all other investment risk, and it affects broad range of securities and mentioned it. Unsystematic risk can be mitigated through diversification. Systematic risk cannot be. That is the bottom line. Okay. Or repetitions, I'll just skip it. Okay. Now, let's look at systemic risk. In other words, for one example of systemic risk is too big to fail. The possibility that a particular event at a company level can trigger severe the ripple effect, instability or collapse on entire industry. I'm not wishing this, but just for example, I'm saying that if there is a major problem happens in RBI or State Bank of India, which is interconnected highly, now that can affect the entire banking system, and not only the banking system, the entire the companies, all the system linked to it. And systemic risk was major contributor to the financial crisis of 2008. If you remember the housing finance crisis, which happened in 2008, which affected AIG, which affected housing finance companies, which affected the entire banking system, because they're all very large institutions, too large, and the failure of them affected all the interconnected people who are related, on them or dependent on them. Ripple effect. So the difference between, it's very clear. Here it's the risk, it's because of the interlinkages and interdependencies in a system or in a market. That's where it has got a cascading effect, even to the company for no fault of it. Okay. Just skip this. I think this chart tells you that subprime mortgage crisis, how it happened. People, the housing finance companies lend to people to buy even a second house, without evaluating their credit worthiness, because they wanted to expand their business, because the greedy management, top management people wanted to expand their business, show a higher top line. They went on giving loans to people to buy even second houses without checking whether they can repay the amount. And once the demand for houses went up, they were happy. But then over a period of time, the people who borrowed are not able to repay. So they started selling the houses, or they started sending it to the companies. Meanwhile, what those housing mortgage companies did was they bundled all those assets together and called them mortgage-backed securities, or MBS, and sold it to the banks who invested in those bonds. And those banks bundled less risky, classified them into less risky and high risky based on the ratings, and sold at a discount and a premium to investors. And to assure the investors, they insured them with AIG. So once the housing prices started falling and the value of the houses started falling, they're not able to sell it. They walked away, they put the house key in a cover and gave it to the banks, take it, and they left. And mortgage payment declined, value of mortgage-backed securities declined, and bank incurred losses because they're not able to sell it. There were no buyers for those bonds and debentures, those securities. And because of which the investors also, started pressurizing. So the insurance company has to pay the insurance. The insurance company the AIG became bankrupt. So government of US had to step in, and the TARP program, TARP, set in. So entire system, it affected the country and went into a lot of problem for the next 1 or 2 years. That led to subprime crisis. With one product, they create 10 products. That's the problem. And many institutions survive on one product. The same product is repackaged, sold it to someone and then pledged with someone. So that's what asset-backed securities or mortgage-backed securities or collateralized debt obligations and credit default swap. I mean, they keep on. And that led to troubled asset relief program by US government to safeguard AIG and various companies. And they also led to quantitative easing, which like a tiger's tail, they were struggling into tapering program was very difficult and they did it finally. Then again, QE came in a couple of years back due to COVID. And that's when, the 2008, the popular thing called jingle mail, where the property owner used to send his keys to the mortgage lender because he's unable to continue the payments. So these are various risks which we discussed: systematic risk and unsystematic risk, controlled by an organization in macro nature. Unsystematic is controllable by an organization, and unsystematic is micro in nature. Systematic is macro in nature, and systematic includes interest rate risk, market risk, purchasing power, inflationary risk, demand, price risk, various things. And unsystematic includes people risk, legal risk, political risk, all these things. So again, reclassification based on different type of risk. Now, this chart is very important. It clearly tells you that the difference between systematic and unsystematic risk and what is controllable, what is not controllable. As you diversify, unsystematic risk keeps coming down. If you notice this, as you diversify, increase the diversification, the unsystematic risk keeps coming down, and because of which the total risk also comes down. At certain point, it stops. That's where the systematic risk starts, which cannot be tackled by diversification. The tool which can be used to tackle that kind of a systematic risk is only hedging. Okay, this chart clearly explains that. And when such things happen, this kind of thing happens, there is something called market cycle. To tackle this risk, we also have to understand the market cycles. There is a long cycle, there is a short cycle. Short cycle could be for a few months or few years. Long cycle could be 40 to 60 years, which was identified by Russian economist Nikolai Kondratev. And he says that he talks about super cycles or K waves or surges or long waves. And they identified the following, since in the last, if you look at last 2 or 3 centuries, they have identified this between 1780 to 1830, when the invention of steam engine happened. That was the period which they say. The second is between 1830 to 1880, and the third cycle, the second cycle was due to steel industry and spread of railroads, and the third boom, or then the bust happened, because every cycle has got a boom and a bust. The third cycle resulted from electrification and innovation of chemical industry and in the chemical industry, and ran from 1880 to 1930. And the fourth cycle was fueled by autos, petrochemicals, and lasted from 1930 to 1917. And the fifth cycle was based on IT, which we all know happened in our generation. From the base or foundation was laid in early 70s, but ran through the present thing. The sixth wave could be due to people differ on that, biotechnology and healthcare. They say people may get extended life of 150 to 200 years going forward, or the other thing is IoT. These are the things which people talk about could be a reason for the sixth wave. And each wave has got 4 sub-cycles: the spring, the summer, the autumn, and winter. The spring is a phase where increase in productivity happens because slow increase in demand. And because of this increase in demand, the inflation will be there. Slow inflation will be there in initial stages, and then which will signify the economic boom. And at the end of this, summer starts, where there is an increase in general affluence level from middle class to upper middle class. The lower middle class will become middle class. The middle class will become upper middle class. The upper middle class, some of them will become so rich, and some of the richest will become super rich. And this will lead to behavioral changes, behavioral pattern towards the work, which results in deceleration of economic growth. If you look at Germany and all, the weekend starts at Friday afternoon. For us, the weekend starts only on Saturday evening in India. So because of that economic affluence, the European countries are able to do that. So that because of which there will be economic slowdown or slow growth. Once people become affluent, they start working late, the hunger is satiated, and they become more, their behavioral pattern change. Then sets the autumn. There will be stagnating economic conditions, which will give rise to deflationary growth, which is likely to happen in US and other countries now. the spiral that gives rise to, different protectionist policies, which you can see that many countries have banned export of food items. Many countries have banned export of cereals and all. And in fact, India also banned wheat. And and luckily India will not be affected by any of these protectionist policies by other countries, because at least from the food self-sufficiency point of view. But many other countries which don't produce even one rupee, for example, Singapore, they don't make anything. But then what will happen if protectionist economy set in? So that is a problem. Then winter, economy will be in very bad shape, depression, like in 1930-32, they call it ketchup economy. People used to go to restaurants, they will not have money to buy anything. They'll simply take the ketchup, mix it with water, drink it, and get out of the restaurant. Ketchup which is kept on the table. Like, these days when we go to our restaurants in India, we have this salt and pepper kept. So you just add both of that in water and drink it and come. Something similar to that was happening in 1930s, the recession. So this will happen, and again after the end of it, spring starts. So this is the typical economy. You have to see that where we are right now in India and the world economy is right now, we can assess it. And by understanding where we are, we can manage, mitigate the risk. We can increase our exposure or decrease our exposure, either to investment or to market, for expansion, for anything. And this cycle, and more about market cycle, not more about quantitative cycle, but more about market cycle is covered in one of the recent books, which is, I think this book was released 3-4 years back by Howard Marks, who is a person from Oaktree Capital. Many of us know Warren Buffett, and people who read a lot knows Warren Buffett's associate, Charlie Munger. I respect Howard Marks almost equal to Charlie Munger, and he has written this book, which is very interesting book about the market cycles and how to mitigate the risk, how to hedge it, and how to take advantage of the market cycles. And these are some of the ways to identify the market cycles or where the market is, particularly this related to the capital market. When you look at capital market, how to identify excessive high. Market is very vibrant, outlook is positive. Everybody will say that market outlook is positive. The rating agencies, I have this habit of ridiculing some of the rating agencies. When they say positive about India or positive about economy, I'll be very negative about it. I'll start selling. When they say very positive, negative about India or negative about things, that's time to buy in the market. So the market, more and more IPOs will come. People will come to raise resources either to, venture capitalists or angel funds or IPO or unlisted space. And more investors will be there. If you look at India, we had 4 crore investors up to 2020 January. Post-COVID, and this took 20 years to achieve that 4 crores number. 4 crore demat accounts opened. The Indian Depositories Act was passed in the year 1996. It took more than 20 years to get first 4 crore investor. But in the next 2 years, it has doubled. Now we have got additional 4 crores, which means more than 8 crore investors are there, or 8 crore demat accounts are there who are investing in the stock market and mutual funds today. Now, this is one indication that market is very optimistic. Market was very crowded. And last 1 year, most of us know that it was very hard to gain entry, because every time when we think of buying, the share prices were up and up and up. And the more and more new IPOs come, new funds come, and the performance at that point of them was strong and aggressive. So it was easy to identify the high. How to identify a low? Very negative sentiment, pessimistic sentiment. The interest rates will go up and people will move their funds towards fixed return securities. People will keep selling. Any upward move, people will keep selling. Any downward, people will not buy. Completely opposite to what happened last year. Pessimistic outlook. And only the best can raise money, that too at a lower premium or a fair price. These are the excessive low. I don't think we are at excessive low as of now, though we were at excessive high last year. But we are more towards the low. What we should understand is market, when it goes up, it will go up. If the fair value of market is 100, it never stops at 100. It will go to 120 or 140. Similarly, likewise, when it comes down, the fair value is 100. It will not come down to 100 and stop. It will come down to 80 or 60. We are at close to 100 right now. It went up to 140. Now we are close to 100 or slightly less than that. The chances are high that we may go to 80 or 85 or 90. It cannot rule that. So that's the way. And I'm skipping all these things. I think these are most of it. Now, The way to diversify. Now, why should one diversify? This is the reason to diversify. We'll discuss only about 3 asset classes and their past history and their market cycles, which we discussed earlier, what part of cycle we are in. This is a chart of gold between 2002 to 2010. In fact, 2012 also it went up to $1,300 or something like that. More than that. Okay. So $1,850. It went up to $1,850 in 2011 or 12. From $285 per troy ounce in the international market. Now, why the gold price went up between this period of 10 to 12 years? 2 reasons. One is Greenspan easing, monetary easing, quantitative easing. A lot of money was available. It started chasing stocks. Once stocks started peaking out, they started real estate. Then they started using that money to buy gold. Then started buying crude in futures market. Crude touched $150 in 2007 peak. Gold touched $1,800 and from there it crashed to $1,150. 1/3 of gold was lost in 2013, 14. I think 2015, if I'm right. I'll show you the chart. Similarly, crude came down from $140, $150 to $30 or $28. I think it came down to $28, something. So, gold, the second reason for gold to go up was the first launch of gold ETF, paper gold, exchange traded fund by SPDR iShares internationally. 2002 or 3 they launched it, and for every unit they sold, they bought 1 gram of gold. So the new younger generation who don't believe gold as an ornament, but they believe gold as an investment, they started buying ETF. And for every unit of ETF bought, it has to be backed up by physical gold, which will be kept in a vault in London. So SPDR invented a new product, which was followed very soon by India also. India ETF, gold ETF was launched in 2003. That led to very big rise in gold. Quantitative easing on one side, lot of money, liquidity available, and gold ETF. And particularly, the gold started going up after 20 years of lull between 1980 to 2000. 20 years, the gold price never went up. On the contrary, gold price came down from $850 in 1980 to $285 in 2000-2001. The gold price came down by 60% or 64%. 2/3 of gold price is gone. In a matter of 20 years, it came down. It depreciated by 60%, 65%. I'll show you the chart. So this is the gold price. Second is a gold chart, is a gold price between 2012 to 2018. If you look at the period between 2012 to 2016, it has come down from almost 1,900 to 1,150. 1/3 of gold price is gone. 33% loss between this period of 3 years. Now, look at long term at 2019, 15 to 2019. Again, 2015, 16 to 19 or 20, it has come up from $1,150 to $2,000. So it had a good run, bad run between 1980 to 2000. It had a good run between 2003 to 2012. It had a bad run between 2012 to 2016, and it had again a good run between 2016 to 2020. Now, if you have invested in 1980, 20 years, you would have never had a return. If you have invested in 2012, you would have never had a return. If you have invested in 2020, last 2 years, you would have never had a return. If you have invested in 2001, you would have had excellent return. If you invested in 2016, you would have had excellent return. So, this, when you invest, very difficult to predict. That's where the asset allocation comes in. Whichever asset goes up, you sell it, have the cash, and when it comes down, you keep buying using the asset allocation model, a simple Excel sheet based model. Now, this is the life cycle of gold. During the same time, what happened? This is a long-term movement of gold. You look at from 1980, 81 to 2002, it never went up. It only came down. Many in India will refuse to believe basically because we have only seen gold price going up, but that is because we import 99% of our gold, and for importing that we pay in dollar, and what went up was American dollar but not the gold price. So we pay more rupee to buy dollar, and with that, when you convert it, it becomes more rupee. So we are buying gold. Now the second asset class which most Indian invest is real estate. And what happened to real estate? This is the RBI published data in the report, Global Property Guide, which says that the red is a nominal, which include the second one is real, adjusting for inflation. So it has from between last 10 years, the real estate price has only come down. I mean, it has not gone up. the percentages increase has come down substantially. In fact, between 19 and 20, it is negative appreciation. So this is what it is. If you adjust it for inflation, it is even worse. It's a skewed trend. So this is RBI data, which is very clear. Most of the returns were earned between June 2010 and 2015 and remained subdued since at 5.5% the year till 2020. And adjusted for inflation, it is even low. There's a clear thing. And if you look at Sensex, it looks a rosy picture, but it is not such a rosy picture if you look at what happened between 2000 to 2001, 92 to 93, 94 to 95, and then 2008 to 2009, and again 2020. What happened if you look at it? It's a bad. So the point I'm trying to make is that you have to have a proper asset allocation in order to participate in all these asset classes. Each asset class has got a cycle. No asset class is bad or extremely good. If you are having asset allocation, you can benefit out of the asset which is in positive side and use it to buy an asset which is downward trend. Whereas most of the investors do the reverse. This is the only way to mitigate the risk. And this is the psychology of market cycle. And most of us participate at the peak and exit at the bottom. In short, I think that's what it is. So if you have time, I'll talk about the current market condition and how to go about it.
Sir, kindly continue, sir. Kindly continue.
Okay. And I don't mind, taking questions. If any questions are there, I can take it.
Some questions have come.
Okay.
My request will be if you continue for another 10-15 minutes, then in the last we can take the questions.
Okay, I'll do that.
Thank you, sir. Thank you. Thank you.
Yeah, I'll share this. Okay, we all had a fantastic year in 2021. Most of the investors, most of the stockbrokers, most of the wealth managers, PMS guys, all of them, in spite of COVID, we all thought that COVID is going to bring in lower business, lower volumes, lower turnover, and we wanted the stock exchange to be shut in March 2020. But what has happened surprised everyone else, and all had fantastic year, basically because of the reasons which I'm going to mention. But before that, what are the negatives in the market? Why the markets are like this? First of all, let me tell you one thing. When the market wants to come down, when it is tired after a long bull run, it will find out reasons. What I say may sound peculiar or unusual, but that's a fact. Market will find its own reasons to come down. When you take positive news, the market will say that is also a negative news. For example, when you say the crude price has come down, so it's a positive news, the market will say that then the refining margin will come down, it is bad for oil companies and various other things. So in everything, market will find a negative reason. But so I think the market had a very good run for the last 1.5 years or almost 2 years, which is one of the longest run in the recent past as a bull run. So it wants to relax, it wants to correct. So that is the rule number one. The reason number one why the market is correcting, first of all, beyond all reasons. Now it is finding reasons. What are the reasons? The rising CPI and WPI as far as India is concerned. But leave alone India. India has got least of this problem. In India, inflation is welcome. People are happy sometimes also, except the common man who is on the road. In a welfare state like some of the states, they are taken care by the government with public distribution system and other things. But the lower middle class and wealth class suffers. But the suffering is much higher in case of developed nations. They are not used to this kind of suffering. They are not used to this kind of inflation, particularly this generation who are below 45 or 50-year-old. They have not seen this kind of inflation because the last time this kind of inflation globally was in early 1980s or late 1970s, when I showed you the gold price, when it went up to $780, $800 and crude price went up to $800. That was the time, when the global inflation was at the highest. 40 years later, now we are seeing 40-year high of 8% plus. Euro economy is 8% plus, UK is 7% plus. I think US is also close to 8% of inflation. And now that is a major problem because when that kind of inflation is there, I've met a few people from UK who say that their electricity power charges, gas charges have doubled in the last 1 year. Not only that, this charge normally they used to collect once in a year, now they say pay once in a 6 months, which means it's almost 4 times. And they're not able to meet this. The lower middle class, the Indians who went and settled, in UK or other countries as lower middle class, they never felt it so hard. The middle class is also feeling the pinch right now. This reality, please understand. This will lead to increasing interest rates. Mortgage rates will go up. The EMI period will go up. Or if some of us have borrowed a vehicle loan or car loan or a home loan or anything, personal loan, the interest rates will go up. The EMI will go up, or the EMI period will go up. It may also lead to crude and gold prices. Thankfully, they have not gone up that much right now, but they went up last year like anything, which is stabilizing at that level, which will lead to higher input cost, higher raw material cost, which happened last year. If you look at the metal costs went up, many people procured a lot, and the stocks are there, though they are cooling a bit now. And when the inflation happens, when the interest rate goes up in US, there will be a flight of capital to US in spite of their interest rate being low compared to India, because margin of safety is higher, or it gives a lot of comfort level for any investor, FI, to invest in debt in US than equity in India, if the rate of return is higher in US, which is what is happening right now. All FIs are keep on selling. And in spite of them selling, the market is not crashing. Market is falling, I agree, but market is not crashing. For the same kind of selling of billions of dollars, which happened earlier in 2008 and all, market should have fallen down, crashed. It has not crashed. Right? If any one of you remember what happened in 2008, the index came down from 21,000 to 7,900. The problem was in US. The economy problem was in US, not in India. India never had a slowdown. Even in 2007-8, we had a growth of 5% plus. But the Indian stock market fell down by 2/3. Market Sensex fell down by more than 65%, 66%. Whereas Dow Jones fell down only by 49%. From 14,000, it came down to 8,000, 7,500 or something. So that is basically because FIs withdrew money. But this time the fall is not that much, in spite of FIs continuously taking out the money, basically because of the additional 4 crore new generation investors who have come into the market. I'll tell about that later. So the next problem could be increasing US dollars, which could be beneficial to some extent for the IT services companies, IT companies, and other exporters to some extent. Unfortunately, it will not benefit them much because the buyers are smart. If you ask anyone who is exporting a coconut pith or granite or any exporter, small exporters particularly, if you ask them, the moment the dollar price goes up, they adjust it in the price. The importers pay them less in terms of dollars. This is a pathetic situation, but this is a problem. Then can lead to a slowdown. I don't expect any recession in India at all. I can say with reasonable confidence, though I'm not an economist, but the slowdown is possible for a short period. And high price IPOs are big failures on listing. This is a clear indication that market is not anymore bullish or strong. Now, there are certain perennial positives in India, which is to start with our Indian demographic profile, which consists of people between 25 to 35 who come from rural India or semi-urban India, who have a lot of requirements and needs to be met, aspiring India, who are seeing big money for the first time. So they have needs. The money is not going to the money is going to large number of lower middle class people who keep buying refrigerator, who keep buying car, who keep buying two-wheelers, who keep buying houses. So the economic engine will keep running in spite of all the slowdown what we are talking about. The number of demat account as on March 2020 was 4.1 crore. April 2022, 9.2 crores, which includes all the demat account, NSE, CDSL, NSDL, who invest in stocks and mutual funds. These people will take care of the market. They act as a cushion. FII selling is observed to a larger extent, and we are fairly insulated from the sell-off. Like UTA, we had UTA in 1992-94. Now these people are the insulation. And timely Southwest monsoon and crypto money, because of the falling prices of crypto. The first generation investors who never invested in stock market, the younger generation who invested in crypto, fashionably invested in crypto, I would say, including my son. But now they are moving, regretting they are selling off the crypto. They are not averaging out. They were averaging out in between. They're selling off and they're getting out of it. And that money will also come into stocks. It is coming into stocks to some extent because market is corrected. They all have not sold it. You know, the people like us who had our Demat account for the last 20 years know when to sell, when to buy fairly. So we all sold a little early probably last year. After that market went up. But then we are in cash. Today we are buying. But these people have not sold it. They went on buying more and more and more because they only tasted success in the last 2 years. Now we have to wait and watch how they will behave. But they have continuous perennial supply of money coming in by way of their salary. So hopefully they should keep investing at lower levels also to average their portfolio. And the UPI QR code transmission, the digital transactions, phenomenal compared to many other countries, even developed countries in India it has happened, which has made an average tea seller in a corner shop, which was always saying that I'm a poor fellow. Now it has exposed him that he is selling a tea worth, its turnover could be a few lakhs in a month and maybe making revenue of about 80,000 to 1 lakh a month, and maybe 10 to 12 lakhs a year he's making. So he called himself a small tea vendor. He's out of the GST net, he's out of the income tax net. Now he's coming under this indirectly. He will slowly come under this also going forward. So I'm just quoting, I don't want them to come under it. I pity with it. But then there are many people who are not coming under this. Now, because of convenience, they have started using this. Because of more business coming in through this, they have started using this. They're forced to use this. So they will come under the tax net and the tax collection will go up. If you noticed, all of you know that the number of taxpayers as well as the tax collection has gone up substantially post demonetization. Okay, but not due to demonetization, but the side effect of demonetization, probably. Many people have come into the tax net. And a word of caution for the IPO. I never bought an IPO in the last more than a decade because it's a skewed market. There is one seller and numerous buyers. I don't believe in any market which is not democratic. There should be more number of buyers, more number of sellers. You can, fair price discovery will happen. But when you have only one seller and more number of buyers, fair price discovery never happens. It's purely based on demand and supply, which happened in unlisted space last year. There was a company called PharmEasy, which was traded at 125 rupees in a peak. Now it is available at 40 rupees. So why? Because few number of sellers, more buyers were there, and the price discovery was not happening in unlisted space. So these are some of the things which we should be careful. Finally, to conclude, I want to touch upon the valuation, current valuation of the market, where we stand. There are numerous parameters to evaluate the capital market and where we stand in terms of valuation. Each one have their own set of valuation, but broadly speaking, for the indices, I follow this. For individual stocks, I take different measures and substantiate that. But then, for judging the broader market, I use 3 parameters. One is price to earning ratio, second is price to book ratio, third is dividend yield ratio. These are the 3 ratios which we use for the indices broadly. And then we follow the nitty-gritties for individual stocks. Now, let us see in terms of price to earning ratio where our Nifty stands. As on 22nd July 2022, which is about 5 days back, the PE ratio was 20.55. The Nifty's PE ratio, which is a composite 50 stocks, their price to earning ratio, which means that for every 1 rupee they earn, they are trading at 20 multiples or 20.55 multiples. In other words, it will take more than 20 years to get the entire earnings if you invest today. This is the PE. Where we were same time last year. Last year, that is 2021 July, the PE of Nifty was around 28.22, and somewhere around that time it crossed at some point of time more than 30 also. More than 30, which is one of the highest in the recent past, almost a decade. So when you look at that angle, we are cheaper today. But are we very cheap, dead cheap, or are we trading at a throwaway price? I don't think so. If you compare it with what happened on March 23rd, 2020, when the lockdown was announced, when the sentiment was at its rock bottom, the PE of Nifty was at 17.15. Compared to that, we are at 20.55. So in one way, we are certainly not anywhere closer to the top. We are much, much closer to the bottom. So that way, when you look at PE basis, we are closer to the bottom. We are much closer to the bottom. And the margin of safety is very high for those who start investing at this stage from now onwards. The fall could be there. I'm not ruling out that fall, but the fall could not be very big. And even if fall happens at a very big level, it will be only a very good opportunity to buy and add more. So this gives us a comfort level and a higher risk reward ratio. For every 3 rupees of or 2.5 rupees of risk we are taking, 3 rupees of risk we are taking, reward could be double that or more than that. Risk reward ratio is high. Then the second parameter, price to book ratio of the Nifty composite of Nifty 50 stocks. For every 1 rupee of book value, it is trading at 4 times right now. It was 4.26 times last year, same time. So which means it has come down. But in March 2020, it was trading only at around twice, 2.17 times. So that parameter, we are not close to the bottom in terms of price to book. So probably we can wait or we can slowly add quality stocks. The third one is dividend yield. Dividend yield should be high when the price is low. Prices are low, when the index are low. So in 2020, March, the yield was 2, which became 1.1 in last year, 1.11, which is very low yield, which is prices are very high. Now it is around 1.4. I am normally happy when the yield goes beyond 1.50 or 1.60, I'll try to buy. When the price to book comes closer to 3, less than 4 and closer to 3, I will start buy. When the P is less than 20, around 18 or 19, I will start buy or I'll buy. So these are the current valuation and to put it in a different way, 2021 was a year where we saw higher tops and higher bottoms, which means every rise, if it is 500 points, the fall will be only 300 points. The next fall will be 600 points, the fall will be only 200 points. So higher tops and higher bottoms. 2022 is going to be lower tops and lower bottoms. The market falls by 500 points, the rise will be only 300 points. Next time, the market will fall by 600 points, rise will be only 200 points. So we should use every rise to book profits in a partial way, but then every low should be used to buy. This is the thing which I gave the beginning of the year. But right now, I feel that every fall should be used to start accumulating the quality stocks, contained stocks. Otherwise, we'll miss out on the golden opportunity, which 2022 and 23 is going to provide us. Next 12 months to 18 months are golden period for any investor to start investing in wealthy companies. Otherwise, we'll start losing our good companies to FIS and we'll say that HDFC is an Indian bank, no more an Indian bank. HDFC is a foreign bank because 75% is held by foreigners. So this is something which I wanted to say. I'll just summarize this. Okay, I think this has changed. Okay, I think with this I will conclude and I would like to take the question.
Nagappan sir, there are 2-3 questions. So
Yeah.
I'll request you to kindly reply to those questions.
Yeah.
One question is that because of Russia-Ukraine war and US inflation crisis, there is a continuously downfall in the stock market. So how we have to protect our investment in the stock market?
How we have to?
Protect our investment in the stock market.
Okay, so this is what, as I mentioned, Russia-Ukraine war is not the only reason. It was probably one of the trigger points for the market to go down further. But market decided to go down last year beyond Diwali. In fact, I have in my Twitter handle, I have tweeted about it. It is still there. Last time around Diwali time, I mentioned that the markets are peaking out and it's more likely to come down. And I'm not happy with investing at this stage. I'm booking profits. And in fact, personally speaking, the only stock I bought at that point of time was only ITC, when everybody was laughing at it. So the only way to protect our capital is that, going a bit contrarian. When everyone is greedy, let us be cautious. And when everyone is cautious, let us be greedy. So I think 2 things are very clear. If we have got caught in wrong stocks, in either which came in IPO or something which does not have any future, we have realized it. I think better to book profit loss and get out of it. Maybe as a prudent measure of tax planning, you can also book some profit and get it adjusted so that the tax is adjusted. And then consolidate, have liquid cash and try to accumulate quality stocks, frontline stocks at every fall. I am looking at, unless otherwise you are going to buy any in the next 12 months or 18 months, having entered in 2022 at a peak and trying to look at it, I think it may take 5 years, in my opinion, to reach that kind of level, 4 to 5 years. So the other way to shorten that period would be to keep buying at every month on a systematic investment basis, either into the good quality stocks which you are already owning, or in a mutual fund with index-based mutual fund as well as a diversified mutual fund, and go for it. And I am personally confident and reasonably bullish on certain sectors which is corrected strongly. I was very strong and bullish about IT and pharma in 2018-19. I started selling them in 21 and 22, 20 and 21. Now I have started buying IT sector and to some extent pharma and to some extent cement. These are the stock, and I'm looking at metals also going forward. And some of the PSUs which are good dividend yield candidates, which are giving 7%, 8% yield at because of the correction, because they have corrected 50%, 80%, 70%, some of them are corrected. I mean, not 80%, 30%, but 50%, 60% they have corrected. Some of the PSU stocks are looking good with very good dividend yield, consistent dividend they have been paying, though they may not be multi-baggers like you expect in case of IT stocks. There are IT stocks which have consistently coming out with buyback at a better price than the market price, are available at a cheaper price now. And the main advantage with IT stocks is that there are 3 or 4 very important advantages. They are blue chips as good as an FMCG company or MNC company, but they're not trading at that PE of 50 to 80. They're trading at 20 to 25 PE. IT companies are trading at 20 to 25 PE. The top 5 companies are trading at such low PE, whereas the same FMCG companies, if you look at whether it is Nestle or Britannia or something, trading at 50, 60, 80 PE. And all these top 5, 6 companies, IT companies are debt-free companies. All these 5, 6 companies are cash-rich companies. They can run the company with the interest that they're earning on the deposits itself. And unlike a manufacturing company like Ashok Leyland or Tata Motors, who cannot sack even one of their employees because of union problem, in the case of IT companies, the moment they get into trouble, their margins get squeezed. They will immediately mercilessly sack some 5,000 people, and their cost will come down automatically. So the IT sector may not do very well, but the IT companies will continue to do well. You know, in India, we say that the company may not do well, they may not be able to repay, but the promoter will always do well. Similarly, IT companies will do well because they can easily scale up and scale down. They can easily control their costs, and they are cash-rich companies and dividend-paying companies and zero debt companies, with most of them owning their own real estate. So I am always bullish on the top 5, 6 IT companies. Keep investing them. That's the only way to protect. If your portfolio is large in size, then the other way to protect is using derivatives to hedge that and making money out of it. For example, I am not advising this to do because I'm not supposed to advise. I'm not a SEBI registered investment advisor, but I'm sharing my experience. Sorry, I'm taking a little bit longer to answer this question because it's a very important question. I had bought large quantity of ITC last year, and last 1 year it was not moving. But how to make money out of that? There are 2 interesting aspects to make money out of the stock which you are holding for long term, but you don't want to sell it in short term, but you want to make money out of it. There are 2 possibilities or 3 possibilities. One is offering them in auction, which used to be a lucrative market earlier, but not anymore. The second option is to go for stock lending and borrowing. You can offer your stock, lend your stock and earn some interest out of it. Okay. The third option is to, if you're long in it, you can go short. Go short means don't go short in derivative futures, but you can, sell a call. So it's a covered call. You are holding in cash, you are selling it in future. So by doing this, the premium, whatever you're writing, invariably last 1 year, it was the moment it cut the technical resistance of 245, 250, then I stopped doing it. So this is one way of making money and protecting your investment. While you are having your investment, retaining your investment, you're also making money out of it in a stock which is not going up at all. Okay, so these are some of the ways which you can explore, provided you have time.
Sir, one more important question has come, which is actually our members want your direct advice. They say that while we are going for investment purposes, how to determine which stock is undervalued or overvalued?
Yeah, see, it is very important. There was I forgot the name of the website. There is a web, I think moneyworksforme.com. I'm not suggesting the website, but I remember that concept. What they were telling was they used to fix an MRP for every stock based on certain parameters. They'll say that this is the MRP for BHEL. The MRP for BHEL is 60 rupees. Now, if it is trading at 50 rupees, it is cheaper, keep buying. If it is trading at 70 rupees, it is expensive, sell it. So something similar to this they were trying to do. I was pretty impressed by that concept. So we should be able to understand that how to evaluate a stock. Now, for valuation purpose, there are different parameters like PE ratio, EPS, price to book, debt equity ratio and all. You cannot apply the same parameter for 2 different companies belonging to two different sectors. Okay. For example, I mentioned one example comparing FMCG and IT. In stricter sense, that is not the right way to select a company, compare these two. I can compare as a sector, these two sectors I can compare, but not as a company. When it comes to a company, I should compare Infosys with the TCS, I should compare Nestle with the Britannia, not Nestle with. There are valuation metrics available. You can use tools like screener.in gives some of them. Filtering mechanism is there. Ratestar.in gives you some screener mechanisms. You can use that. Whether you agree with it or disagree with it, not my personal view is that I keep looking at. I spot a company based on 2-3 parameters. One is fundamentals, ratio analysis, or price to earning, the continuous growth, the product, and all those things. I mean, the second is qualitative aspect, which is the management bandwidth, the capability of the management to tide over a tough situation. And also the management credibility, the track record of the management, how they behaved in the past, whether they have rewarded the shareholders enough, whether they have rewarded that way. Most of the IT companies score much better because they have been rewarding the shareholders continuously. Some of the pharma companies have been rewarding the shareholders continuously, whereas some of the automobile companies have never rewarded the shareholders. Look at the cement company; most of them have not rewarded the shareholders except 1 or 2 continuously. And the management bandwidth, when I spoke, how they handled it. Look at Tata Steel acquired a bad acquisition, Tata Motor acquired a bad acquisition, Tata made a good. So in 2008, then how they tided over the situation and came out of it. So the management has got the bandwidth, the management has got the credibility, then I choose that company. Without these two, there is no point in chasing because there are good promoters, that is in the sense that they are very good promoters, but they are inefficient promoters. I will not go for that company. I will not suggest you to go for that company. There are very efficient promoters, intelligent promoters, but they're not good promoters. They're bad promoters. I would also not suggest you to go for it. What is needed is the promoter should be good and his intent should be good and he should be efficient. If he is good and inefficient, no point in investing in that company. If he is efficient and bad, then there is no point in investing in that company. He should be good, he should be efficient, and the numbers should reflect it. Their past track record should reflect it. This is one way of filtering it, qualitative way and quantitative way. After applying these two, now you have identified a company. You know that this company is good management, efficient management, honest management. They reward the shareholders regularly. Then you identify this and keep a list of this in different sectors. I want one in stocks, one in automobile, one in diversified portfolio. Now don't buy it immediately. Now, what I do is that I will try to arrive at a price based on all these parameters like PE. The industry PE is 30. This stock is trading at 20 PE without any particular reason. I'll buy it. Okay, industry book price to book is 3 and this is 2. And 2-3 parameters I will use it to buy them. But I will not buy immediately. I will fix a price for it and wait for that market to come down. There are many times we have missed an opportunity where the price has not come down to that level. The key in the market is waiting. The mutual fund investor will tell you that if you're a mutual fund investor, you should not wait. You go for an SIP. But if you're a stock investor, you have to wait for an opportunity. People will ask me, sir, last 1 year, we never had an opportunity. 1 year is too short a period in your investment cycle. We had a plenty of opportunity to invest in 92. I will start as early as 88 recession talk. Then 92 fall after Ashok Mehta. 94 post December 6th. Then 2001 post Y2K crash is the fourth one. Fifth one is 2008 crash. Sixth one is the fall which happened in 2013 prior to the 6 months prior to the elections. Then the seventh one, what we saw is in demonetization in 2016 December, where a stock like ITC was available at 150, SBI was available at 150. I'm not even talking. EID Parry was available at 105 in March 2020. In this last 30 years, I've seen the market crashing 8 times, which means once in 3 years or 3.5 years, we see market crashing. It is just that we have to wait for that opportunity. Some people may take it otherwise, but I say this: in India, every bad news is a good news. Wait for a bad news. It may sound cynical, but my intent is not that. In India, every good news is a bad news. Don't compare India with other countries. We have a different demographic profile, and use that bad news. Our political stand could be different. A particular measure which government has taken, we may not agree with that or agree with that. That's a different thing. But then, because of that or not because of that, the market has come down. Make that opportunity to grab the shares at good volume. So valuation metrics, if you ask me, it varies from person to person. Some people used to ask me, sir, what kind of boy you are looking for a daughter? I'll say that if I say that I want a tall boy, and if they come and show me a 6-footer, which is at 78-year-old, can I marry him? I don't know. My daughter likes I may do that, but I don't know. So there is no one single parameter. It's a composite parameter, qualitative, quantitative, and I give more importance to qualitative filters than quantitative factors. Then the third thing, very important thing, the entry exit points I decide based on. There I use a little bit of technicals, the support and resistance, the broader bandwidth where it is there. I don't use technicals for day trading. I mean, you should use it for day trading. I don't use it because I don't do day trading. But I use it for the broader, not only DMA or longer period daily moving averages, support and resistance points to enter and exit a particular stock, whether it is the right price to enter, combined with this. It's a combination of various factors I use. And over a period of time, if you really ask someone who is driving a cycle or driving a bike or driving a car, just teach me how you teach drive. Simply say that it's a composite thing. Over a period of time, we won't even realize. First time when we start driving, we'll say that we have to press the accelerator, we have to press the brake. We'll consciously remember everything. But after a few years, we may not remember anything. It will happen automatically. We'll be on the phone talking to someone. We'll be driving the vehicle, and simultaneously we'll be listening to music. All these things happen. That's what happened to people like us over a period of time. Thank you.
So one last question.
Yeah.
Sir, he says, sir, with the ease of availability of information due to internet and due to increase in retail investors, do you think Indian markets are becoming susceptible to investor frenzy like USA, where recently retail investors were able to hike up price of some shares like GameStop?
I don't get the second part of the question.
They say that since ease of availability of information due to internet, there's an increase in retail investors in India. But do you think that like Indian markets are becoming susceptible to investor frenzy like in USA, that they help in hiking up the prices of certain shares?
See, it can happen anywhere in any market, and markets are like that. Markets are designed like that by default. The frenzy happened last year. The young investors never listen to the senior investors. The senior investors are the people like me also was skeptic about the market beyond the level. In fact, if you ask me, the mistake I did was selling early. And I started becoming skeptic and a little bit negative when the Nifty was at 16,500 itself, 16,750. From there, it went up to 18,000. It crossed almost more than 15%. It went up. I've lost that last leg of the market. But I don't regret. I don't mind. I have never bought at low. I never bought at high. I bought somewhere in closer to the low and sold somewhere closer to the high. That's all. You can call it a failure or you can call it a fairly good success because I made money much better than the benchmark indices or benchmark returns. So that way I'm happy, contented. So, but this maturity comes only after 2 or 3 bull runs and bear runs. Whatever somebody tells you, experienced person tells you, nobody will listen to you. They will only laugh at us. But once they really experience that pain and pleasure, the joy of making money and the pain of losing money, there is a psychological study which is done. If somebody is making 10 rupees, the pleasure is 1. Somebody is losing 10 rupees, the pleasure is twice. I mean, the pain is twice. You are making 1 rupee, you're losing 1 rupee, 2 different scenarios. But the pain is only 1 time. I mean, pleasure is only 1 time, but the pain is twice for the same kind of loss. This is a psychological study which is done over many people, as a part of a research. So the newcomers, I'm waiting to see how they are going to behave. The investor who was in the market for last 30 years or 20 years will keep making use of every rise to sell, every low to buy. Whether the new investors will do that or they'll get scared and run. That's what I did in 92. When the market fell down, I sold everything and ran. And I realized 2 falls and 2 gains later in 2001 or 2, I realized that this time we should not get scared about the fall and I should start buying. It almost took 10 years for me to I would not say master the market, but at least to understand the market. These days, with all the information available and all those things, they will be much more matured. And they also read very good books. Last 10 years has a very good subject which is called behavioral finance and behavioral economics. At least about 10-15 books has come by Nobel laureates. Like Richard Thaler has written a book called Nudge 2 years back. which our chief economic advisor used in his economic survey. And Richard Thaler, I think Thinking Fast and Slow by Daniel Kahneman is another Nobel laureate who wrote a book called Thinking Fast and Slow. Predictably Irrational, that's a book written by Dan Ariely, one of the oldest book. And Fooled by Randomness is another book written by, Fooled by Randomness and Black Swan Event are books written by Nicholas Taleb. These are the books in no way related directly to the stock market, but indirectly related to the stock market, because these are all based on economic events, psychological happening, and art of decision making in pressure circumstances. So I think people are reading those kind of books also. They will become more matured to an extent that today Flame University is conducting a 3-day, 4-day, full-day program on behavioral finance under Professor Sanjay Bakshi. So I think I believe they are matured investors. They will not flee away like I did in 92 or 94. They will average and buy out because India is a growing economy. India is a good economy. The friendship will be there. They will make their own mistakes. They learn on their own. That's how they will come. Like crypto, what they did in crypto. Many of them, when I spoke to many youngsters, they may not have told me personally, but I know that they are laughing at me that I'm an old man and not understanding the new concept. But now they have realized it, and they are going to the other extreme of selling everything and putting all money into stock markets at one go. So they will learn, fall, get up and learn. I don't think they will go the US way, because one advantage in India is that in US, they simply believe funds, they simply believe fund managers and go. In India, there is an element of distress on anything and everything, so they will question and they'll be careful.
Sir, thank you very much. We had a wonderful session with you. We are grateful to you for explaining the various concepts pertaining to capital market and what are its perspective from the top management. And we look forward to your association with the academic activities of the Institute again. Thank you very much. Thank you.
I also thank ICA. And,
Thank you, sir.
Thank you.
Thank you.